You are listening to RLA Radio. I'm your host, Dennis Tubbergen. Glad you decided to tune in again today. Hey, if you're a new listener, welcome. This is where we talk about what's going on in the economy, what's going on this week, especially in politics, and what's going on in the markets and how you and your money might be affected. If you are a new listener or you are a returning listener and you don't yet have the RLA app downloaded to your mobile device, you can go to retirementlifestyleadvocates.com, and at that site you can get our weekly market update webinar replays. You can get the weekly podcast version of this radio program, and you'll also get our weekly newsletter, Portfolio Watch, and you can get those resources on that site. You can also download the app and get those resources delivered right to your mobile device. Well, I would be remiss if I didn't mention that we had an election this past week, which obviously everyone is aware of. And it appears, as I am recording this on Friday afternoon, that the outcome of the election is still to be determined. There is certainly going to be a lot of ongoing litigation related to this election as well. Of course, as an inquiring person, I wonder why, in the age of blockchain technology, in the age of computers and telephones, that we still are using mail-in paper ballots when there are so many other alternatives that we could use that would make the United States election process not be so inept and appear to be so inept all around the world. So why do we use paper ballots? Why are we doing this? Well, I am reminded of what Arthur Conan Doyle, the creator of the Sherlock Holmes character, once said. He said that as you think about things, the first thing you want to do is eliminate the impossible. Then you'll be left with the truth. I will leave it at that because the outcome of this election will certainly potentially change some of the policies that will affect you and your money. And in this segment, I want to talk to you about one of the policies that likely will not change. That is the policy of quantitative easing or money printing by the Federal Reserve. Now, again, if you're a new listener, the Federal Reserve is the central bank of the United States, and the central bank of the United States is comprised of a private group of bankers, a private group of corporations. That surprises many people when I talk about that, but 107 years ago, nearly, in December of 1913, then President Woodrow Wilson signed into law the Federal Reserve Act. That gave private bankers control of monetary policy. Now, since the beginning of the year, according to Alistair McLeod, a past guest here on the program, over a period of 30 weeks, the money supply expanded by 65%. And if you compare that to the money supply increase from from 2008 until the beginning of 2020, you saw an average increase annually of between 9 and 10%. So we have had significant amounts of money printing taking place. And Ray Dalio said this. Ray is a billionaire, founder of Bridgewater Associates. He is a hedge fund manager. He said this: large government deficits exist and will almost certainly increase substantially, which will require huge amounts of more debt to be sold by governments, amounts that cannot naturally be absorbed without driving up interest rates at a time when interest rate rise would be devastating for markets and economies because the world is so leverage long. See, there's already a lot of debt that exists. And if you're a lender and you're going to loan money to someone who's already up to their neck in debt, to use that expression, there's certainly a much higher loan risk than someone who has no debt. So certainly if you're going to loan them money, there's a lot more risk involved in loaning them money. And in order to compensate you for that risk, you're probably going to want to have a higher interest rate attached to the loan. Well, it's impossible, as I'll talk about with my guest in the next segment, Mr. David Skarica, it's impossible to finance the level that exists in the United States at interest rates that would be more normal. It would literally bankrupt the country. And yet, they're talking about more spending. In fact, this past week, Jerome Powell, who is the current chair of the Federal Reserve, said this. He said that the support provided by the $2.2 trillion CARES Act, which was passed back in March, he said it was absolutely essential in supporting the recovery that we've seen so far, which has generally exceeded expectations, which is true. But he said further support is likely to be needed. My question is this. Assuming there is more support, assuming there is more stimulus, where will the money come from? The federal budget deficit soared to a record $3.1 trillion in 2020. The federal government spent $6.55 trillion. Tax receipts and other revenue were $3.42 trillion for a $3.1 trillion deficit. That is a record by a long shot. Now, the Fed is creating money to fund this deficit, and my point is this, and here's how this affects you. Regardless of the outcome of the election, this policy is very unlikely to change. And money creation causes eventually inflation, or at least pockets of inflation where demand exists. Money creation is a tax on savers and investors. Because as the dollar buys less, and we saw the dollar take a pretty big hit last week, as the dollar buys less, so does your savings, and so do your investments, and so does your nest egg, and it makes it more difficult for you to retire. In the best-selling book, Revenue Sourcing, that was released earlier this year, I talked about the fact that there are strategies that you can consider to help you overcome this near certain risk, in my view. Now, again, if you'd like to get more information or learn how to get more resources, I would encourage you to visit the website, retirementlifestyleadvocates.com. You can also, at that website, download the app, as I mentioned at the outset, and the app will give you access to all our resources. So the question is this: how long will the money printing continue? And the answer to that is, I don't know. However, one of my favorite economists was the late economist Herbert Stein. He said, if something cannot go on forever, it will stop. If you've been a long-time listener to the program, you have heard me use that quote before. If something cannot go on forever, it will stop. Those words are as simple as they are profound. To do planning, you have to make sure that the planning is done before it stops. You have to make sure that you're safe before it happens. And that's why I'd encourage you to visit the website, retirementlifestyleadvocates.com, to get more information. You can also, as I said, download the app there. I will be back after these words with this week's special guest, Mr. David Skarica. Welcome back to RLA Radio. I'm your host, Dennis Tubbergen. Joining me once again on today's program is my guest, Mr. Dave Skarica. Dave is the publisher of the newsletter Addicted to Profits. You can learn more at addictedtoprofits.net. And hey, Dave, welcome back to the program.
Thanks for having me. You're in this very interesting time.
Well, yeah, as we're recording this, we are waiting to see the results of the U.S. election. It seems like there's just a lot of crazy stuff going on, and certainly we could talk for multiple shows about that. But what do you think that does to the markets?
I just think, right now we kind of saw this knee jerk where the markets rallied, and if you just look at, let's just take the results at face value right now, regardless of what happens in the next month or two in terms of litigation and the whatnot. It essentially looks like, you have Biden the presidency, but the one upset that looked like happened is that the Republicans will retain the Senate. So that kind of gives you gridlock. And you remember, I'm not an overly political person, but in terms of, but I am, I fundamentally in my belief system, I'm a libertarian. So, the Democrats were looking at, raising capital gains taxes, and they would have done a lot of fiscal stimulus, which would have helped certain areas of the economy. But I think in terms of the stock market, obviously by raising taxes, that might have hurt it a bit because, you're going to have a much higher capital gains tax, right? And you might want to lock in your gains now. But now with kind of the Republicans in the Senate, maybe you don't have the fiscal stimulus, but you do have, you don't have the large tax increases. Like maybe in a few years, they'll just let the tax cuts by Trump roll back, but you're not talking about these, draconian measures to the tax code and the whatnot. Now, just so longer term, I think something's going to have it happen here. Because even though I'm a libertarian, I'm also a realist. With the national debt now $27 trillion and the debt to GDP at all levels of government north of 150% of GDP, you're going to have to probably have higher taxes. And I probably, kind of similar taxes that we see. I'm Canadian, they see in Canada or Western Europe are going to happen in the States because they're going to have to raise revenue to basically close this budget gap at some point, right? So, and I don't care how low rates are, even if you're paying almost no interest on it, like Japan, I think pays 15 or 20% of its government revenue in interest payments because, their debt's 250% of GDP, even though they have zero rates because just the debt level is so high. So I just think that at some point you're going to have to see that happen anyhow. But in the short term, which, the market, they always say looks out, 6 months, 9 months, that doesn't look like it's going to happen. But I think on the other side, I think other markets are kind of more interesting. You've seen this kind of really big dump in the dollar. The dollar is starting to break down. A lot of foreign currencies, Canadian dollar, Australian dollar, euro are all starting to break out against the dollars. And of course, you could say that Bitcoin and gold and precious metals are their own currencies. They're moving higher and looking to break out too. So it looks like what's happening is, I think this kind of ineptitude in the political system in the U.S., which, by the way, has now been going on for years, not just an election. Maybe this election has been nail in the coffin for it, or the most extreme example is kind of, I think, having people lose faith in the U.S. dollars. And you look at all this debt that's been issued, if you take the foreign ownership of debt as a percentage of total debt, foreign ownership in nominal terms has gone higher because, people are buying U.S. debt because, just because there's so much being issued, but there's so much being issued too. Their actual total ownership of the total amount is going down. So that's also, to me, I think it's actually something like a 10 or 20 year low. So that to me is also signaling a loss of faith in the U.S. dollar. And I think we're going to see more of that going forward. And remember, and one thing about that fiscal stimulus, even though as a libertarian, I'm not a huge fan of blowing up the debt more, but short term, it does increase GDP growth. And a lot of times these foreign currencies will outperform the dollar because they're expected that their economies will outperform. And it doesn't look like, to me, in terms of economic performance, the U.S. is going to do much better than Canada or Europe or most of the countries in Western Europe, or definitely going to underperform places like in Asia. So I think that could also be leading to this kind of weakness in the dollar. One thing about the election, what I found interesting, is not just all this stuff going on with the votes, but during the debates, during the campaign, during everything, I never heard the debt and deficit mentioned once. Remember when Ross Perot ran in the 90s, that was one of his main platitudes he ran on was, the debt and deficit were out of control and the country was going to go broke. And, back then, the debt and deficit was a few trillion. Now we're getting close to 30 trillion and no one is even talking about it. And I think because people have been lulled in complacency because of these low rates. So you're not seeing it hit the bottom line of the government finances yet. Because the simple scenario is this: okay, the debt and deficit are up tenfold in the last 20 to 30 years, right? But rates, for example, from 40 years from the early 80s, are down from 15 to 0.5%. So if your debt goes up tenfold, but the rates go down 90%, you're actually essentially paying the same amount of interest in nominal terms. Of course, the economy is much bigger now, so it's not really, because interest eating up your whole budget is basically how countries go bankrupt and go into a bankruptcy. That's essentially what happened to the Weimar Republic, or what's happening in Venezuela. So that's what's happening. But now with these ultra low rates, it's not being felt yet. But like I said, there is some point where there is a tipping point, or even if you have these ultra low rates, the debt gets so large, even at low rates, the interest payments start, squeezing into the budget. And remember, that will be happening in the next 5 to 10 years while the baby boomers are retiring and outlays are increasing too. So that's another thing, is that the structural deficit, meaning that the deficit you're going to have like every year, not just because of some stimulus because of a coronavirus, is going to get larger. And that essentially will, again, continue to increase the debt. And again, like Europe has, in Canada, Western world has similar problems, but places like Asia do not, because they don't have a baby boom. They don't have government pensions en masse like we do in the West. So I really think that, and I started talking about this in the late 90s when I first started out, and it did happen, from about 2000 to 2011, where the emerging markets outperformed, and they've underperformed the last 10 years, but I think we're going to see another 10 to 20 year period where emerging markets begin to outperform.
So, David, to go back and talk about the relationship between the dollar and GDP, I just read a piece on this by Alistair McLeod, and I found it fascinating. Since GDP is measured in U.S. dollars, the argument that he makes is that, are we really getting GDP expansion? Because when you measure GDP in terms of gold, you get a completely different picture. What would you say about that? What would your reaction be?
I would say that's the truth, because another thing, too, is, you've got real GDP growth as well, right? Because after inflation, and if gold and commodities or the U.S. dollar is going down against other currencies, which increase import costs, which is inflationary as well, if inflation is going higher and is really at 5 or 6%, not at 2%, and you're growing at 2-3%, are you really growing at all? Right. So, and then there's other things like population growth that all factors in as well. So, yeah, I would agree with that. I would say that if you're getting, these foreign currencies and these signs of inflation going higher, you're not really growing as much as you think you are. And look, I think that's kind of seen. Like, look, we can all look around. You live in Michigan. I'm from a town called Hamilton, which is kind of a depressed steel town. Like Hamilton's basically the Detroit, of Canada, or was. It's had a resurgence recently, but and it's like you can look around and see that, hey, 30 years ago, I don't care what the GDP per capita was or GDP was, or what the rates were a lot higher, but people just seem to have more money, like more money for vacations, more money to spend on, like, I don't know, a pair of shoes or sneaker or tennis racket. That seems to me that people had much more disposable income. And that might in itself, just like looking, kind of doing the eye test, might be the most simple kind of example of that people didn't have to get into debt to buy big ticket items or luxury items, and now they do, and because partly because they can, because debt is so cheap. So I would say, yeah, a lot of those GDP numbers, for lack of a better term, are BS, and they don't really represent people's standard of living or their day-to-day costs.
Yeah, well, and BS is a highly technical financial term, so we all understand that. So, David,
yeah.
let me jump in here in the 3.5 or 4 minutes or so that we have left here. Powell, the chair of the U.S. Federal Reserve, has pretty much come out and said we need more stimulus, which is basically him blatantly saying we need to print more money. It seems like we're going down that road. And, Herbert Stein, the late economist, said that if something can not go on forever, it will stop. And certainly money printing, I would think, fits in that category. What do you think the end game looks like here? How does it stop, and how will our listeners potentially be affected?
I think the end game is the bond vigilantes. I know that no one thinks that can happen anymore. They think that central banks can do like MMT and just keep rates depressed and basically subsidize all this government spending. But what I think what makes the U.S. different, and I'll give an example, a historical example in a second, but say from Japan, that's what the excuse people, the example people use. Oh, Japan has had this, debt going on for 20 years now, 30 years now. But if you look at the makeup of the Japanese, first of all, their society, we're seeing all this instability socially and economically and politically in the States. The Japanese really don't have that. They're very stable kind of society on a social level. And then they own all their own debt. Like the Japanese debt is all domestic owned, right? Where the U.S., I said that percentage is going down, but still got 40% of its debt owned by foreign governments, foreign central banks, foreign investors, et cetera. So I think at some point they could be inclined to dump because they might say, hey, you go look at the political system right now. They might say, "Hey, we're not supporting this dysfunctional system any longer, right? We're not doing this any longer, right?" It's kind of like when Rome got dysfunctional, people refused to pay their taxes to support like a corrupt central government in Rome. And another example I'll give is after World War I, the UK was a superpower. Their debt exploded, and the world did subsidize it for about 20 to 30 years into World War II. But then after they were really broke in World War II, they had to get an emergency loan from the Americans after the war. And then if you remember in the Suez Canal crisis, the Americans basically threatened to dump that debt if the UK proceeded with with that transgression. And then that made the UK back out because that dumping of debt and spike in rates, crash in the pound would have basically sunk their economy. So I think at some point, it's the return again of these form of bond vigilantes when you got the debt high enough where remember like we don't need a big spike in rates. If essentially rates went normalized like 3 or 4% on the 10-year bond, which historically is extremely low, the government essentially would be broke at the federal level. So I think that if you're going to take at some point this fiscal irresponsibility will be met with like skepticism and threatening to do that, and then it doesn't matter. And then if the Fed has to buy, like let's say, $5 trillion of bonds wants to be dumped, what will happen is you'll totally debase the currency, and you'll get super high inflation, and that's that. So I think the end game is essentially people running out of patience with the exponential growth in debt. I think that's kind of the end game. But the problem is we don't know what's going to happen. The classic example I use just to end off here is that in 1995, I bought a book. I was just starting out as a teenager, getting interested in economics and finance and markets. And it was by Harry Figge, and it was called Bankruptcy 1995. And it was about how the debt was going out of control and the country was going to go bankrupt. And here we are 25 years later, and the debt is 10 times as high as it was back then. And we haven't seen any of that. So the problem is these things always take longer than you think. But when they unravel really quickly,
Well, to show you my age, I have that book in my library as well. We are chatting today with Dave Skarica. His website is addictedtoprofits.net. Stay with us. I'll be back with Dave, and we'll talk some more after these words. Welcome back to RLA Radio. I'm Dennis Tubbergen, your host. I'm chatting today with Dave Skarica. Dave is the publisher of the Addicted to Profits newsletter. His website is addictedtoprofits.net. And Dave, in the last segment, we were talking about the fact that, the end game is that essentially the Fed, the United States, prints so much currency that people say, look, enough is enough. And that's happened many times historically. So that's got to be bullish for tangible assets, doesn't it? What's your take?
Yeah, I think that like when you look at QE, people wonder why did QE not increase? Actually, the last 9 or 10 years we saw a decrease in the price of precious metals until the last year or so, and we saw decreases in the prices of most commodities. And actually, there's a great chart that shows commodities, priced compared to the S&P, and they're almost as cheap as they've ever been. And people go, well, why all this printed money didn't? And I think the answer is quite simple. And I think that simple answer is that actually, because that suppressed volatility just put people into risk assets. People went back into housing. They went back into the financial markets. A lot of that printed money just went on banks' balance sheets. And, they're involved in more of the financial community. So now that we're talking about more of an unraveling of the system and the government debt, I always use the quote after the financial crisis, because the government debts are so much higher now than they were in 2007, is that, in 2008, the government's bailed everyone out, but then the next crisis, who's going to bail out the government? So I think we're looking at this macro kind of aspect going on where it looks like more like this is going to be a sovereign problem rather than, a private, financial crisis at the bank or individual level. I think that just means the printed money this time will go more into these kind of commodity or inflation hedge instruments, because people will see the massive debasement of the currency. So that means, gold, silver. It's obviously my two favorite, especially because I do a lot in the junior miners, which have a lot of leverage. And, especially if gold goes, north of 2,000 again, and silver, north of 25. I think that's when you see the big leverage come into those. And then, Bitcoin and cryptos would do well as a hedge. Once you kind of get the shakeout in kind of the frackers and supply comes out the market, oil will probably begin to rise again. The mixture of devaluation and stimulus probably help the base metals. Agricultural prices are really depressed. So I think virtually all of these commodities, kind of like what happened from 2000 to 2011, or like happened in the mid 30s to just about the end of World War II, or like happened in the 70s, you're going to see now this period where, inflation assets do really well, and I think this will be even more extreme because I think we're seeing the kind of demise of the superpower of the world and its currency. So that will even help that even more. And people don't realize that after the Great Depression ended, like the bad part of it, 1933, and until 1951, commodities soared in price, partly because of demand, because of the war, a lot of money printing during the war. And obviously part of the reason probably too is because the British pound, which was the reserve currency, went down a lot and lost its reserve currency status. And as a lot of things were priced in pounds in the 30s and 40s, they would have gotten more expensive. So I think that's kind of scenario we're about to see here in the dollar,
So, Dave, let's talk about the relationship between the price of gold or the price of silver and how mining shares in general, as a group, collectively, relate to that.
Yeah, so like you have more leverage in the mining shares because you have fixed costs, right? So the quick example I like to give to people is if a mine's all-in cost, meaning putting in construction, then its year-to-year cost is $1,500. Well, at $1,500 it makes zero, or $1,501 it makes $1. But at $1,900, all of a sudden it goes from making zero or $1 to $400. So you can see the leverage there, and that would be leverage to the stock price. Of course, it works on the downside because if gold goes to $1,200, then all of a sudden you're losing $300 for every ounce produced over the course of the life of the mine. So they have leverage in that regard. And see what makes the junior miners so leveraged, and the reason I like to use them on top of you get private placements and you can have warrants, which basically give you the right to buy more stocks. So they're that sort of thing is that if you have it's just, again, simple math. If you're, say, a large gold company, you got 20 million ounces in the ground, well, you find a 1 million ounce deposit, that only increases your asset base by 5%. Well, if you're a little junior miner that just got a couple 100,000 ounces of ground, you have a big find and you find a couple million. Well, you've increased your asset tenfold, plus the value of that asset in the ground is going up, as gold rises in price. So that makes them like hyper leverage. And a lot of these companies have very small market caps, in the tens of millions. And again, it's a lot easier for, say, a $20 or $30 million company to say go to be worth $500 million with some exceptional news than it is for like a $2 billion company to be worth $10 billion, right? So That's why I like them. Just the small size of them, the fact that they're financed mostly with equity, so you get these warrants attached to them. With me personally, I've been in that industry for over 20 years, so I know a lot of good, solid management who have history of finding mines and putting them into production or selling them to majors. So I think that is why I like them in kind of bull markets, and because I kind of know the industry as well. I have the opportunity to get in a lot of these things on the ground floor. So, it's not like I'm getting into a junior deal after it's run up 5 or 10 times and they have it. I'm looking to get into it right from the start. Now, not everyone's going to work out. It's a very risky sector, but usually if you're going to do 5, 10, 15 of these deals and you know the people behind them, in the long term it will pan out.
So, Dave, let's just talk a little bit about your forecast for gold and silver. There seems to be no end in sight, as we talked about, to the Fed's money printing policies. So is it a fair question to say where do you see this going, in the near term as far as the price of gold per ounce and the price of silver per ounce?
Yeah, it's difficult to know because you guys talk about the money in circulation. I always like the Dow to gold ratio as a long-term deal, and I think obviously the market is overvalued. We could see a decline, but again, because of inflation, I don't know if we'll see one of these 70, 80% bear markets like we saw in the NASDAQ in the 2000s or the Dow in 29 or even the financial crisis and the market fell over 50%. But we could see a 20 to 30% drop mixed with huge inflation, which in real terms makes it go down a lot. So let's say the market, the Dow ends up trading around 20. Well, if you look at that 1-to-1 ratio, where these things usually end in the gold precious metal market, that's 20,000 for gold, maybe 10,000, whatever it may be. I think that's a pretty fair price based on the amount of money being printed, the amount of debt being run up. I remember with the deficits. I'll end on this note, and this is why I think gold can go so high. Even if they don't do a stimulus, the tax base has been decimated. The amount of money that they have to spend is now higher because there's more people on benefits. Baby boomers are retiring, so that makes Medicaid, Medicare, Social Security expenses all higher. That increases the structural deficit probably to between $1 and $2 trillion a year. So the Fed is going to have to probably monetize that, even without some kind of stimulus, right? So that's why I'm so bullish, because if you're going to run the $1 to $2 trillion a year deficit for whatever, the next 4, 8, 12 years, it's kind of hard to see gold going down. And there's no political will, in the states to do that. Because even, let's face it, from a fiscal standpoint, the Republicans have been just as bad, if not worse, than the Democrats. So nobody wants to cut spending because that loses the elections. But if everything plays out like I say and these debts blow up, probably the government be forced to at some point. But yeah, with the kind of this uncontrollable debt out of control, I don't really see how this is going to really stop anytime soon. And I just think even with the Senate being, if it is controlled by the Republicans, even then, I still think they'll have to make some kind of deal on a stimulus anyhow. And it might not be as big, but you're still going to get more money printing, more spending, bigger debt, etc.
So are you more bullish on gold or silver moving ahead?
I'm still more bullish on silver because that gold to silver ratio is still roughly 80-1, which historically is a high level. And, it was like over 100-1, which I think was an historical all-time high. And I think the median is like 60-1. And then, at extremes, it's gotten down to like when the Hunt brothers manipulated silver, it got down to 16-1. But I don't know if we'll get to that again because, like I said, silver got manipulated for a few months then. But yeah, definitely getting down to 20 or 30-1 is definitely reasonable. So let's say it just goes to 40-1, just to be conservative. That essentially would mean that silver would go up twice as much as gold. So if you got a $10,000 gold price for argument's sake, you'd get whatever, that would be a $250 silver price, which again, you do the quick math, 10,000, that would be 5x on gold, and it would be, 10x on silver.
So, to what extent do you think the gold and silver price have been manipulated? This is probably the last question we have time for. I mean, you had a major firm just pay almost $1 billion in fines to settle, criminal and civil allegations that they were kind of rigging the silver market. Another big bank happened a couple of years ago. What's your take?
I think they do that in everything. These banks are just. I think when we look back at history, one of the things that caused all this kind of unrest we're seeing, this now political failure, was the biggest mistake ever was when they bailed out the banks. Because those are probably the most corrupt institutions on earth right now. And remember, they've gotten those penalties for, doing the LIBOR rates, doing MBS securities. Like, they always get penalties for everything. So, yeah, I think there's a form of manipulation in there, but I just think they do that with everything because they're basically corrupt. So I don't know if it's more manipulated than anything else. I think there might be an aspect in there because if gold and silver go up, it's a sign that the system, we can see the system is crumbling anyhow, but it's really a sign when they go higher because you can see some kind of tangible evidence of it through their prices, right? So I definitely think it plays a part, but I think the banks have got, their hands in the cookie jar of so many things. It's not as big as people think because they're just, they're trying to, scrub off points everywhere to make money. Like there's been bank fines where they've basically been working with international drug lords, right? To make money off that trade. So the banks kind of have their hands in a lot of things, and I think there is that somewhat going on. But let's call a spade a spade. We had a huge run in gold and silver prices into the summer. I actually informed my readers plus myself to sell about 20 to 25% of our position in the summer, awaiting this correction. I think now is the time to start re-entering. But it was just a normal kind of technical consolidation and correction. So I think people do get a little carried away with the kind of the whole manipulation kind of scheme. And the banks are they got their dirty hands in almost everything. I'm a big Miami Vice fan of the show back in the 80s, and there's this one great scene where they go into a banker because they're trying to hunt down a drug dealer, and the bank's totally within the ends, with the drug cartel, and the speech the banker makes is I was like, I don't know who wrote that, but they definitely had some brains because the same thing's happening 35 years later, right? And anyhow, that's all I'm trying to say is that the banks are in so many dirty businesses. It's almost like the mafia in a way. It's like the mafia has a lot of legitimate businesses too, right? But they also get involved in shady illegal stuff. And so yeah, I don't know. I don't stay up at night worried about manipulation, especially because now I think the system is kind of losing control over the ability to do that. And I think the next shoe to drop is, like I said, we saw financial crisis. We saw, this, and then the next shoe to drop will probably be, the Corona thing this year. The political instability is probably when the governments fiscally cannot bail out everybody like they have these last two crises, right? So that's probably it. And by the way, that's going to be really bad because again, when I go back to what I said earlier about the issue with them bailing everybody out at the banker level, well, that made the bankers even more corrupt, even more above the law. And then because they got a bailout, everyone got a bailout, during the Corona crisis now, airlines, people getting inflated unemployment checks, et cetera. And then now if in the next crisis, it's a government debt crisis, no one can get a bailout because the government won't be able to afford it. And with everyone expecting bailouts now, it's kind of like anything, right? It's if you're at a job and you're making, I don't know, good money, $200,000 a year, and all of a sudden the company does bad, and you're expecting that $200,000 a year, and they're like, hey, we're still going to pay you $150, but we're struggling. Losing that 50 hurts a lot more when you become accustomed to it. The extra positivity and the lifestyle gives you, et cetera. So that's the issue. I see here is that, essentially we're going to see this next decline being the government decline. and then they can't bail everybody out when there's, a negative downturn in the economy. And it's the perfect example of this, the standoff, is back in the 18th century when it was much more of a laissez-faire economy. When you had those banking crises and financial crises, no one expected a bailout. It was like you would go bankrupt and that would be it, and you would have to start over again. And ever since kind of FDR started the New Deal and having the government more actively involved in the economy, now everybody expects government bailout. And what happens when, the government can't? And we can see this in places like Venezuela or Argentina, where the government, because they've had so many of these crises, doesn't have the financial ability to bail everybody out. People, starve, there's high unemployment, people leave the country. So that's going to be the kind of next shoe to drop. It's not exactly the most positive thing in the world, but again, it's the timing. Who knows? Like, could it happen quickly, within the next 4 years? Could it be like after 2008? After 2009, we had an 11-year expansion. Could we have another 11-year expansion before that crisis starts? I don't know. So it's, those are the things that are almost impossible to time.
Well, the clock says, Dave, we're going to have to leave it there. My guest today has been Dave Skarica. His website is addictedtoprofits.net, and I will return after these words.
Thanks.
I'm Dennis Tubbergen, and this is the Retirement Lifestyle Advocates radio program. Glad you decided to listen in today, and thanks again to my special guest, Mr. David Skarica, for joining us on today's program. In the first segment of this program, and during my conversation also with Dave today, we talked about the fact that this money creation or money printing is likely going to continue, and one of the ways to protect yourself is to have some tangible assets in your portfolio. Now, again, I'd encourage you to go to the retirementlifestyleadvocates.com website. There's resources available there to help you sort through all these options and apply them to your situation. And as I mentioned, you can also get the app there as well. But think about how the banking system currently works. Now, I have been of the opinion for a very long time that this system is a bad one, and it, at some point, will have to break. And that's what we talked about during my interview with Dave Skarica today. But think about this central bank. This central bank creates money, literally out of thin air. The member banks loan out that money. They collect interest, so they get back more of this newly created money than they loan out in the first place. This is a really good deal if you're a banker. However, if you're a consumer, it's not such a good deal. First of all, you're paying interest to a bank that has literally created money out of thin air. That's not a good system. Just think about it. And as more money is created now to fund all this deficit spending, if you're saving and investing and you're hoping to have a comfortable, secure retirement, that is another strong headwind. As this money is created, you lose purchasing power, and this simple phenomenon explains the wealth gap. I would argue that the solution to the wealth gap is not political. The solution to the wealth gap is to have a sound money system so everybody has a level playing field, so to speak. We have resources, as I said, available at the Retirement Lifestyle Advocates website. The web address is retirementlifestyleadvocates.com. You can request more information there. You can download the app. I would encourage you to do that. Also, this month, we have a newsletter, the You May Not Know report, that we are distributing to our clients. It will talk about what's going on economically and politically and give you some ideas as to what you might want to think about doing with your money. If you'd like to get a copy of that, simply go to the Retirement Lifestyle Advocates website and shoot us an email, and we would be glad to mail you a copy when it is released. That's all the time I have for this week. Glad you decided to tune in. I'll be back again next week.